Now, say hello to the internet.
Okay. Good afternoon, everybody. We're really pleased to have John Keel here today. And, we got a sold out crowd today. Everybody's interested in not paying taxes. So, good topic. Now, John is a partner at Carl Smith Ball. He's been their partner for a long time, worked for the IRS. I've known John since I was 4 years old. And we lived in a duplex together, and the wall separated our houses. We lived in an immigrant neighborhood and behind Chun Hun, Kawila Street. And my first fight in my life, and he doesn't remember this, was with John. And I was about 6 or 7 years
Oh,
old.
you beat me up.
Yeah, I beat you up.
Oh, gee. He's 3 years older than me.
So that's my claim to fame. But anyway,
There were like probably 11 people on your side of the wall and duplex, right? And 10
Yeah,
people on my side.
that's right.
Crowded,
Yeah. So anyway, John Keel, let's have a warm reception for him.
Oh, thank you. Thanks for taking your lunch hour and coming over to listen to this. I hope we can make it relevant. And this is the topic: taxation of distributions, retirement plans, overview strategy. Can be very, very complex. And of course, the point here with all the diverse backgrounds, we will just keep it, overview and big picture strategies. And I would expect, for the most part, when you're dealing with these issues, you have advisors that are taking care of you and raising the issues. But it's good to know the issues and be familiar with them, so when it arises, you have some familiarity and some notion as to what it's all about. So ask questions as we go along the way, and if it gets too technical, just catch me afterwards anyway, and we can talk about it. So we're dealing with qualified retirement plans. That's like 401k plans, profit sharing pension plans, and I'm talking about it in a generic way, but there are a lot of details in different types of plans, government plans, non-governmental plans, certain plans for exempt orgs like that. So we're dealing for the mainstream qualified retirement plans, where I would think most of you, in private practice, you probably set something up so that you could set aside money in a tax favorable basis. So I have this outline. It was out here, and I'm not sure if I'm going to be flipping through this. Can barely see, right? So why don't we just start with saying that a qualified retirement plan is a tax-exempt organization, sort of like a church, meaning that it's a plan document, which is a unilateral contract, and there's an associated trust that holds money. But the great thing about this qualified retirement plan is that it's the only thing where this happens in the tax law, where contributions go in and you can deduct it. The money is in the trust and it grows tax-free. And even though you have a vested interest and benefit under the plan, you're not taxed until you actually receive the money. And that seems like so obvious, but really, in tax law, if money is set aside for you and you have either constructive receipt or economic sort of interest in it, you could very well be taxed even before you receive it. And so the general rule regarding taxation of a retirement plan is when you get it, you're taxed for federal purposes. It's taxed as ordinary income. And when it comes down to state law, we'll talk about it further on state law and the fact that the state of Hawaii has an exception for pension payments. And it's very interesting. The guidance is really terrible, but maybe it's just really the trick is who you pay as your accountant and what their viewpoints are. So, so that's just a general tax. So it's in terms of saving taxes, I don't know. How much, we have tactics for that or not. But so we start with the idea that a qualified retirement plan has all these rules. And if you mess up with these rules, the IRS can go in and disqualify the whole thing. And the rules relate to eligibility, vesting, when distributions occur, to whom, what form they occur, and all these rules that must be complied with in order to maintain its tax-exempt status. So that when there's a problem with it and you violate one of these rules, the IRS would say, this is like atom bomb kind of thing. It's like, well, the trust that holds $1 million in assets is now a taxable trust, so you got to file trust tax returns. And for the period of time that you didn't comply with these rules, all the deductions are denied. So we'll go back and you have to file the minute returns. And the $1 million you have in this plan is all treated as includable currently to you, so you have to pay taxes immediately. So it's like a disaster. So it's but all of you, I'm sure, rely on your consultants like that, and hopefully they do a good job like that. And it's really interesting. In the past, is when you see a violation, nobody wants to make a move because it's like an atomic bomb. I mean, you call it and it's like a disaster, and the IRS would never want to do it too, because the IRS realizes that if they call it, it hurts a lot of participants, and that's not their motivation. So now there's a whole scheme of correction program where you incentivize to go in and do the correction and salvage the tax situation. But in the plan document, first of all, it's like for distribution, taxation of distribution, know that when a distribution occurs, all dictated by the plan. And the plan says basically on death, disability, termination of employment, you trigger a distribution. And so that's just a general rule. And you all, as the employer, if you're the employer, have control over what the rules are. And just want to say that there are ways of getting your hand on the money if you want to, usually it's to defer it, right? But at times, if you want access to the money and start it sooner, there are ways to do it. And there's something called in-service distributions. A plan can be written so that you can get the distributions currently. And just as to describe what that is, basically on a pension plan, like the ERS, or like not too many places have pension plans now because it's too expensive. But the earliest they can pay it out to you while you're still employed is 62 years old. So that's, but for a profit sharing 401k plan, you can write a rule that says if the amount's been in the plan for a couple of years or you fully vested, you can take your money and you can actually withdraw it even though you're still employed. There's other ways of getting access to money, which is you can borrow money from the plan. That's a standard rule that basically says that you can borrow 50% of your benefit up to $50,000. And you got rules about paying it over 5 years back by payroll deductions, etc. So you have access in it that way. And in the case of another way of pulling out money, it's probably not a happy situation, but if you undergo a divorce, a qualified domestic relations order where the parties go in and split up the pension assets, and the assets are, as a participant, is going to your ex-spouse, that amount is, of course, can be made currently payable as well. And so that's the fact that you're triggering the distributions, you have access to your money. And then when is it actually paid? And then you got rules there. You got rules after rules after rules, and it's like terrible. But when the amount is $5,000, the plan can say it's so small, we're gonna pay it to you, and you have no choice. So you cut a check and you pay it to the person. It's interesting if the amount is over $5,000. Even if you want to pay out the money because as an employer you're thinking it's complicated. We don't want people here for the past 10 years holding their account, and now they're working with somebody else for the past 10 years. But what's interesting is when your money is over $5,000, the participant has a right to defer the distribution to age 65. So, because they lack momentum, they have the money in the plan, and they figure, I don't have an investment program, why not just keep it in the plan? And so theoretically, the person has $10,000 and they're 25 years old, they can say, keep it, I'll keep it in there and benefit from the investment program. You got to keep track of me until I'm age 65. It happens. And part of the task is to minimize administration, is to basically get people out of your plan, because you don't want to continue to maintain contact and responsibility for money of people that you haven't seen for such a long time. And then there's once a person is entitled to money, well, if it's over $5,000, they don't have to take it. But at some point, you have to make an offer to provide it to them, and that's in the outline. It's basically when they terminate employment or they hit 65 or whatever normal retirement date you put in your plan. And then there's rules about the form of the distribution. The form of the distribution, if it's a pension plan and you're married, the law says you have to pay it out in the form of a joint and survivor annuity. Life annuity for you as a participant, spousal survivor annuity unless the spouse waives, and things like that. But for a 401k plan, which we're more accustomed to in private sector, is that the distributions are normally paid in a lump sum and paid out immediately. But there are rules when you're required to take, where you're required to make the payment, but it would then be up to the participant to defer it, though. Like I said, they don't have to take their money. So that's the takeaway here is just realizing that a qualified plan is quite complex, and there's a lot of variation in it. And to the extent that you are, in private practice or in a position that you have a plan, that you have control over the design of the plan, you can design the plan to provide for various distribution methods and to provide for access to the money sooner than later. So that's the concept. Now for retirement plan, there's I guess this is on for Roman 3, the required minimum distribution. So the concept here is that you have this tax-exempt organization, people can save for retirement, put in money over your working life. But the IRS, is concerned about that money not being able to be deferred forever. It's for the purposes of retirement, and what the IRS wants to make sure is that this amount is actually distributed out to you during the retirement years. They want to make sure they collect taxes on it before you die. And so you cannot hold it to your death and pass it on generation to generation. You got this thing where you got to go and take out your money. So what are those rules? That's it's called the required minimum distribution 401A9, and what it is that you have to start taking out your payment by April. You guys probably know this rule or heard about it. April 1 of the year after you attain age 70 and a half. So, but in the case you're not a 5% owner, it's the later of April 1 following 70 and a half, or when you actually terminate employment. So the rule is different whether you're a 5% owner type that is running the employer and you have an ownership interest versus an employee, a rank and file employee. So rank and file employee, you could be 95 years old and still working, you have the money in your plan, and you're not required to take it out. And then we'll talk about it, but when you do leave, you got to take it out over kind of short life expectancy in that case. And then, but in the case of a 5% owner, we could work to 85 or whatever, it doesn't matter. When you hit 7 and a half, you're going to have to start drawing out the money. So some of you might have been in this position already, but remember I said it's April 1 following the year in which you attain age 7 and a half. So, and that's the first distribution year is let's make I'm 7 and a half today. And what happens is 2018 would be viewed as my first distribution year. And what I would need to do then is to take out a distribution for this year. But I have until April 1 of next year to take it out. Then in 2019, I got to take it out by that April 1. But for 2019, every year thereafter, there's a minimum distribution. So that first year is a possibility that for the first year, you're taking 2 payments in year 2. And then thereafter, you're taking 1 payment a year after that. So how do you calculate these RMDs or retirement, these minimum distributions? It's basically over the life expectancy or joint life expectancy between the participants and a designated beneficiary. So what you have is a table, and the table is giving an age and telling you how long you're supposed to live on a joint life expectancy, where the table reflects that you are at that age and you have a beneficiary that's 10 years younger. It was complicated before because you'd have to figure out who the beneficiary is and you'd have all this variation, but they have a uniform table now. You just assume your beneficiary is all just 10 years younger. And then what you do is, okay, so it would be for, if I take my distribution out for a year, you take the last valuation date, which is, like if I'm entitled to a distribution this year, typically you're taking a look at December 31, 2017, and you take that balance and you divide it by that divisor that's based on this table. So, the 70 is like 27.4 years on a joint life expectancy basis. You divide it up, you get an amount, and that's the amount you got to pay out by the end of the year. So what's interesting, this is a recalculation thing. What happens is every year you live, you're expected to live longer. So you're never gonna die that day or the next day. You always have some more room. And for that first 70, if it's you're 70 and the life expectancy is 27.4. It's assuming on a joint expectancy is like you're gonna get these payments until you're 98 years old. But if the drift is you want to defer as long as you can, there's a rule that says that an exception to this is that if you have a spouse and then the spouse is younger than 10 years difference from you, then in the case of a spouse, you can actually use a table that's based on her actual age. So if you so happen to be my age and you're married to a 20-year-old spouse, it means that the minimum distribution could be quite small because the divisor will be, a long life expectancy, and that's perhaps the incentive to minimize distributions by, having the longest life expectancy as possible. So. And then there are rules about what happens, not that you're alive and taking these distributions, but what happens when you die. And basically the general rule is that, if you're 60 years old and you die, the rule is that if you have a beneficiary and what happens is that the general rule is that you have to complete the distributions in 5 years following the date. 5 years. Counting the plan years beginning after the plan year in which you die. And you got to then pay it out during that time. Alternatively, if you die and your beneficiary commences the payment by the end of the plan year after you die, it could be paid out over his or her life expectancy. So anyway, there's rules about how to take it out when you die. And of course, all this, again, the underlying rationale is to make sure these payments are coming out so that you got to pay the taxes on this stuff, and you cannot really pass it on. And this is kind of common sense. You're thinking, if I'm going to pay these out, why don't I just do I get credit if I pay the amounts early? Then I can pay less later, and it just doesn't work that way. You don't get credits or whatever. It's just every year, whatever the amount is, you gotta go apply these formulas to take out the money. In the case of a qualified plan, you have to do this for your particular plan. But in the case of IRAs, if you have like 10 IRAs, what you can do is you basically aggregate all the assets in the IRA, calculate the amount that's supposed to be taken out, and you can pull it out of any one particular IRA to satisfy the rules. And there's a certain technique when we talk about the state tax treatment that becomes relevant in this regard. So I'll kind of mention it later. And then so it's kind of it's on the face of it a disaster if you don't take your money, because if you don't take your money, the amount that you don't take is subject to a 50% tax. Quite confiscatory, right? So if you're supposed to take out, $50,000 and you fail to do it, I mean, you're gonna cough up the $25,000 as a tax, and then but it's maybe not as bad as you think, because what happens is that this is how it usually happens. Oh, and by the way, the tax is not on the employer who might have goofed up, not on the plan that might have goofed up. It's on the recipient. It's the participant's got to cough up the tax. But the reality is that when you have a plan that you're running, the employer is kind of taking responsibility for the administration. It is keeping track of the minimum distributions, et cetera. So usually if you mess up, the solution is that the employer would engage me, and we will do it by way of a correction program with the IRS. And this correction program is really streamlined. You tell them what happened, you explain it, and the rule is generally is that if you're not a 5% owner, like a rank and file person, they will automatically waive that penalty. So the employer, if they're doing their thing in terms of going in and get it corrected, you'd be safe. Not all employers may do that, and so if they don't do that, what happens is you file an attachment to your tax return and you pay the taxes, and you can include an explanation and pray for forgiveness and ask that the amount be waived, and then you see what happens. But you cannot go ask for forgiveness and not pay the tax. You got to pay the tax and ask for forgiveness, and then at that point in time they have the money, but they do return the money if they waive the amounts. So the takeaway for this is that about RMDs. It could be drastic. If you're getting towards your retirement required beginning date, be considerate about to be expecting it. Maybe plan around how you're consolidating your retirement money to pull it out, and expecting what the amount would be based on those calculations. And so, any questions or? Okay.
Yeah, John.
Yeah.
The 50% tax is for failure to take out your RMD amounts. What happens to the bulk of the money that's still in your IRAs when you die? How much are your children or beneficiaries taxed on that amount?
Okay, so that's like a kind of a different angle, but the general answer there is that remember, I didn't distinguish IRA versus a qualified plan, but on death, typically the IRA would say the entire amount is paid out in lump sum, or it could be that the amount is paid out over a life expectancy and over time. But you would essentially control how it's going to be paid out. I mean, to some extent, the IRA document can read a certain way. Otherwise, it'll just be a requirement that you have to meet these minimum distributions. Again, either you pay it out completely or you're paying out over life expectancy. If you fail one of these methods, there's a shortfall in the amount, and then the tax comes into play. So, yeah. Now, what we're talking about is this idea that you got to take it out by a certain time. Then you get the other reverse as well. Is that if you're putting stuff in for retirement, the IRS is saying you got to put it in for retirement, so you shouldn't be taking it out too early. So that's why there's a tax, premature distribution tax, that you gotta pay to the extent you're pulling money too early. And that's an interesting tax, because the way it works is that it applies to everything, but there's exceptions. And the exceptions, page 5 at the top, the exceptions is the way most people think of it. Oh, I cannot take my money out until after 59 and a half. Well, that's the exception, that if you're taking it out before 59 and a half, you got to pay the tax. But if you take it out after, the tax is not applicable. The exception are listed, 59 and a half. In the case of death or disability, the amounts are paid out, you're okay. And there's a couple here that are kind of more relevant here, is that you can always take out money in substantially equal payments over time. So, well, to make it clear, the backdrop of what I'm saying, the nature of this tax is that it's not as if it's an atom bomb thing where you blow up the situation by taking out money too early. So there's no illegality about taking money out too early. It's just that there's a price to be paid because you got this 10% premature distribution tax. But you know, it's an economic decision, or you try to squeeze into one of these exceptions. So the kind of two big exceptions. One exception is that you take it out over substantially equal payments. So for some reason, in personal circumstances, you know, you're age 58, and you need money, and you got this money in this retirement plan, you want to pull it out, and you decide, I got to pull it out. And then, then you say, you know, the way I can do it is at least I can calculate it. It's enough for me, for my needs. I'll pay it out in substantially equal payments over my life expectancy. And then, and I'll avoid the tax. So that's a strategy, and you do that. But there's this rule that says you do that at the beginning, but what if later on you stop making these payments? Well, what happens is substantially equal payments, you got to keep on doing it. And if you don't do it long enough, it messes up, and you got to go back and treat it as if it were all included when subject to the penalty taxes, and you got to pay the penalty taxes along with interest. And that rule is that if you start, you got to keep on doing it for the later of 5 years or the attainment of age 59 and a half. So if I were 58 and I'm doing this, and I'm escaping the tax for the first couple of years, I got to keep on doing it at least till, what did I say, 58, so 63, right? And then once that happens, I can stop, and I'm kind of home free. But just saying that there is a way of taking out in that way to avoid the tax. Another way is that in the case of a qualified plan, this doesn't apply to an IRA. In terms of a qualified plan, when you terminate employment after age 55, you can actually take out your money and avoid the tax. It doesn't apply to an IRA, but for a qualified retirement plan, that's the case. And there's other exceptions. You know, domestic relations order, payment to the spouse, ex-spouse, exceptional tax, payment for education expenses, and things. So again, so the takeaway here is this concept that it's not impermissible to take out your money early. There's a price to be paid by way of this premature distribution tax. However, there are exceptions to the tax, and perhaps you can, you know, fall within one of the exceptions. Now, what we've been talking about is the normal situations where you're putting money in, it grows tax-free, and then when you take it out, you got to pay taxes. And the concept there has traditionally had been that by the time you take out the money, you're in a lower income tax bracket. You've generated all this tax-free income, and you're pulling out at a lower tax bracket, and you got the deductions when you're at a higher tax bracket. I mean, I don't know if that makes sense anymore. There's that's questionable actually. But there's something called Roth accounts, and the Roth account is something that reverses that. A Roth account is you know, if you think about the pre-tax deferrals under a 401k plan. A 401k plan, see, so this is like assuming maybe you're familiar with, but many people may not be, is that a 401k plan means that you got your salary, and you can basically say to the employer, reduce my salary by $18,500 for an annual period, and if you're 50 or older, you can add $6,000 to that, so it's at $24,000. So basically, whatever your salary for the year is, you make an election, and the amount is reduced. And that amount of reduction is not in your W-2, and you don't receive it, but it's credited to the retirement plan, and you invest it in that plan. And it's all pre-tax. You got a deduction for that amount. And then when you pull it out, you pay taxes. Okay, so a Roth is you have to have a 401k plan. You have to have the same sort of mechanism going on. But the big difference is that when you put in your $24,000, it's treated as still in your W-2. So you don't get the immediate deduction. It goes in, it's in your W-2, and you pay taxes on it. But when it's credited to the 401k plan, it is growing tax-free like all your other investments. There's separate accounting for it. And the good deal is that when you take it out, whenever you take it out, if it's a qualified Roth distribution, you don't pay taxes on it. And of course, you shouldn't pay taxes on the amount that you put in and you pay taxes on it. But you don't pay taxes on everything, including all the earnings. And so that's a really attractive thing for, especially if we have children, they're young like that, is that, for them, putting it in grows over a long period of time. And the big difference between somebody like them and me is that for us, we only have so many deductions, right? We get the mortgage, the state and local taxes, and 401k. So the 401k deduction is like a bird in the hand, and it's like real, and you figure, okay, at least I'm benefiting with some deduction. But so you would have to give up that. But if you give it up and the amount and it grows like that, at the end of the day, you pull it out and you don't pay any taxes on that amount coming out. And the other thing too, it's not subject to those RMD rules, required minimum distribution rules. So at 70.5, you don't have to pull out the money. You can keep it till you're 96 years old, but on death, it has to be paid out like under those RMD rules. You got to pay it out to your beneficiaries. So what's a qualifying Roth distribution? Well, qualifying Roth distribution is basically you put in the money, and it has to be pulled out after it's been there for at least 5 years, and after 59.5 death or disability. So if you meet those requirements, you start pulling it out. You avoid the tax. So that's a Roth, yeah.
On distributions, if you at retirement, you're not taxed on the return of capital, right? Just the
Exactly right. Just the earnings. So all of it is not taxable basically, because the return on capital, you kind of have a basis in there already. So, but nothing is taxed. Yeah. Oh.
What about, is this subject to state income tax?
No, I mean the state, uses the same rules in terms of piggyback, in terms of the state taxes.
So, if there's a Roth, started with 10,000, then that's not taxed because we paid tax for it, right?
Yeah.
So at the end of the 100,000, it's now ballooned because of the stock market. So when we take it out, is that the 90,000 appreciation? Is that something that we have to pay tax on or not?
No tax. Yeah. So the other thing is that there's something called Roth conversion, and so this is the kind of people that they have $2 million in their pension plan, and they have $25 million outside their pension plan, and for them it's like, well, if I can, create any sort of tax benefit, why not do it? I'm not looking for, I just want to save the taxes, and I'm not looking for deductions, whatever. But what I'm saying here is that for them, there's something called a Roth conversion, where they can take that $1 million in a plan and convert it to a Roth account. So what happens is that $1,000, that $100,000 or $1 million that used to be pre-tax is now immediately after tax. And so what does that mean? They still got $1 million in a plan, but they have $1 million of taxable income in that year. And so they pay the tax because they got a lot of money outside the plan. But that money in the plan is now working for them tax-free as a Roth account. And they manage it as a Roth account. So that's like a Roth conversion. And for that to happen, you have to have the plan permitted, just like the Roth account. So that's all, like I said, that you guys control the design of your plan. You go ahead and write it sort of the way you want with certain of these features. Now, this is the Roth 401k plan, but there's also Roth IRAs, which is the same concept that there's income limits in terms of putting in $6,500 a year for your Roth, but you can do something like put in $6,500 on a non-deductible IRA and then convert it to Roth and things like that. But you just get all these things with IRAs that, but that's the nature of the Roth IRA. Yeah. Okay. So when distributions occur, I think one thing is common knowledge is that you can avoid paying taxes on it to the extent that the distribution is an eligible rollover distribution and you can roll it over. And basically you can take distributions and roll over money generally, but you cannot roll over, obviously, I mean, kind of obvious is that the RMD, that wouldn't make sense, right? The law says you're forced to take out your required minimum distributions according to those tables I said. You couldn't then take it out and put it into another plan or an IRA. But the exception is, you cannot roll over RMDs, and you cannot. There's a rule that you cannot roll over an annuity payment. But generally, you can roll over amounts to a plan. And so rollover is, I guess, a common parlance, right? But what that is you get two ways of rolling over. Is that one is a direct rollover, where, okay, I'm leaving my employer, there's $100,000, I make my election form, complete my election form, and I check I want a direct rollover to a particular IRA that I identify. What happens is that $100,000 is directly transferred from your trustee of the qualified plan to the trustee of your IRA. You never see the money. That's it, and then it's not taxable. You get a 1099 indicating the situation, but it's just not taxable. The other kind of IRA is before direct rollovers occurred, you used to have what they now call 60-day rollover, right? That's the one where you never had rollover. A long time ago, you didn't have rollover. So the $100,000 is paid out to you, but in order to not pay taxes on it, you take the $100,000 and deposit it to the IRA, and then you report that on your tax return, and that's a tax-free rollover. And that still exists. So you can do it sort of both ways, but for efficiency purposes, you just as well do the direct rollover. But you have the situation where people think, okay, let me, I'll take the $100,000 and I can use it for 60 days. I don't know what you're going to do in 60 days with $100,000, but, so I'll use that in some way. But in order to prevent tax, by the 60th day, I better have $100,000 to roll it over, otherwise it's a taxable distribution. So that's the thing with the 60-day rollover. Oh, and the 60-day rollover is subject to 20% withholding. So that messes you up, right? So you take your $100,000 as a distribution, but you only get $80,000 because $20,000 is withheld. And then it comes down to like rolling the money over. But you cannot just roll over the 80,000 because you got to roll over the 100. And then so you got to find $20,000 to make sure that all of it is non-taxable. And then you do that. But it's not as if you lost the 20, right? The 20 is with the IRS. It's just that you don't have it. And then it's credited to your tax liability for that year. And so, but that kind of messes you up. But what was interesting for a long time, there was this kind of abuse that had gone on, not so much with qualified plans, but IRAs. So what would happen is that a person may have, 5 IRAs with all kind of money in it, and say they want to take out $10,000. So they take out $10,000 from one IRA one, and they spend it. And what happens is that before 60 days, they go to IRA 2 and borrow the $10,000 to repay the IRA 1, and they keep on doing it. So essentially, that was a sort of gimmick or strategy to basically take your money, use it, but never having to pay the taxes on it, because you just kind of keep on taking distributions and rolling over money. And they stopped that by saying that there's a rule that if you do the 60-day rollover from an IRA, you're entitled to do it once in a year. So that kind of put a stop to that. One change is that it used to be that in the event of death, a beneficiary gets $100,000. They'd have to pay taxes on it, and the only people that could roll over money was a spouse. But the rule changed so that now every designated beneficiary is able to roll over money. But the difference here is that when you're dealing with a non-spousal beneficiary, the person has to roll over the money by way of a direct rollover and can only do it to an IRA, cannot do it to another qualified plan.
Is that the one you just stated, is that like a traditional?
For the yeah. I was actually talking about a qualified plan, but it would be you can roll over between you can roll over between IRAs and Roths. So there's all these permutations of these things, but I think in that area, you can do the rollover.
So John, is it called a beneficiary IRA when you rolled it in?
I think what you're talking about is an inherited IRA.
Inherited.
Yeah.
Okay. And
It's an inherited IRA.
Say it's a Roth, inherited Roth. Is there a minimum distribution out of that? What is?
I believe so.
Okay.
Yeah, I believe so. If you want me to check it out, let me know.
Okay.
The thing is that this IRA stuff is like, unless somebody gets into problems, which you generally don't hear because you have all these investment industry and all these advisors. But one thing is that a lot of those questions don't come to us in private practice. I mean, and the reason why is that we're dealing a lot with the employer plans, so what people are doing on an individual basis. But anyway, so and another interesting area is what I talked about, alluded to earlier, was the state of Hawaii pension exclusion. Who's with the state? There's a couple of people with the state that can clean up these rules. But for the pension exclusion is that if you have compensation that is paid as a pension for past services, this amount is not included in income for state tax purposes. So it's excludable. So the statute basically just says that it's compensation that's a pension for past service. So on the basis of the statute, one could sort of like broadly interpret that, saying any sort of deferred compensation plan could be subject to exclusion, and people, take some aggressive approaches. But
So I'm kind of a hybrid. I have some deferred comp, but I haven't rolled it into private. So it's probably best for me to just leave that alone, let it grow because it's grown, and then when I'm ready to do something with it, then it's not subject to the taxation that you've been talking about. Rather than
the state tax?
Yeah, the state tax.
Yeah, let me go through this because when we go through the rules, and then we'll.
Because I'm tempted because I don't have control over that, or else I can do self-directed or control that. But it's nice, it's performing well where it's at. So rather than disturb and move it into my my managed account or my self-directed.
Yeah, I'm sure that a lot of decisions that drive this area is really not tax driven, but investment driven. I mean that's
So I'll let you go.
that's really but for the state tax exclusion, like where I said, with federal income tax, you're always paying federal income tax, but for state, a pension for past services is excluded. So what is a pension for past services that's excluded? The one thing that's clear under the regs is that a pension distribution due to death or disability is clear. That's not included in state income. A distribution because of an RMD, the required minimum distribution that we talked about earlier, is not included in state income taxes. And what is included is clear is that anything that's subject to that 10% premature distribution tax is included. So that's the one where I guess for a private plan, if you terminate employment after age 55 and you pull out your money, it's not subject to that 10%, but that's not by negative implication saying that it's not necessarily subject. But what we know is that if you're pulling the money before 55 and the premature distribution tax applies, then it's going to be, subject to. But beyond that, the regs also say that just because you terminate employment and you take out money from your pension plan, it doesn't mean that it's excluded because it has to be a pension due to retirement. And that's the crazy thing is like, what is retirement? And especially, for lawyers, self-employed in partnerships like that, what is a retirement? And I think what is clear is this, is that if you have a pension plan and you basically have the plan that says retirement age is 65, and at 65 you basically terminate employment, retire, you stay at home watching K-dramas, and do nothing else, I think the state's going to say, okay, that's a retirement, or if you go golfing or whatever. But you got all these other scenarios, and something like that exact scenario, except for the fact that the person is now going to work with the state AG's office, or going across the street and working part-time with another law firm, or actually working at the golf course as groundskeeper because you want to play free golf. All kinds of situations. And the question is whether that's a retirement or not. And so that's part of the difficulty as to taking money out and taking a position on that state tax exclusion. But I would say that I don't. It's kind of a low bar to me where you're dealing with a lot of practitioners. I think about this sometimes. I raise issue with executives with big amounts. They want an opinion, that kind of stuff. But you're preparing a tax return. The person terminated employment. They're getting this money in lump sum. They decided they needed to buy something. It's paid to them. It's a retirement plan. It's a qualified pension plan. They got the money. They terminated employment. Excludable. I mean, and so I think a lot of the tax preparers, I don't think necessarily they think all that deeply about it as to what constitutes a retirement. But as to whether that person is then reemployed or that person is just, continuing with another job, so that's an issue. And the other issue that comes up in this case is that what is a pension? And the state regulations say this. They say that, how I talked about the 401k plan, you put in $24,000 a year. And then on top of that, the company may be putting in their contributions, matching contributions, profit sharing, whatever. Okay, and then you get this money in your plan. Well, for the state pension exclusion, the state's position of the regulations is that when you put your money in, even though the federal tax law treat it as if it's employer contribution, that's why you don't pay taxes on it, that they view it as personal savings and investment income. So they distinguish elective pre-tax deferrals as not being a pension, whereas company money being put in the plan as being a pension. So what happens is that if you have 25% of the contribution was your pre-tax deferrals and 75% were employer money. When you take out the money, there's an exclusion ratio that is applied. And so it's basically of that dollar, 75% is excluded because it's attributable to the company's money. And the 25% is taxable because it's attributable to your 401k savings. So that's how the state interprets it. Now, the thing about this is that it's a good idea to be cognizant of records on this, because when you take money out of a plan, maybe your accountant's going to do roughshod qualified retirement plan. I don't know. Just everything is excludable. But if you apply these rules, it would be to apportion it out. Amount attributable to your pre-tax contribution, amount attributable to company contribution, and how do you actually get this done? You need information. The other idea is, of course, to not to have to apply this exclusion ratio. You don't have to apply the exclusion ratio if you are doing separate accounting. There's actually separate pots, and it's invested separately, and all of it is accounted properly. Then then the other extends that when you take a distribution and you do a rollover to a conduit IRA, you can roll over all your money to an IRA. For state law purposes, the character of that money is it continues. So when you move money over to an IRA, there's something about said again in the IRA to make sure you're accounting for it properly, or perhaps doing it in two different IRAs. So the one that's coming out of one is not subject to state tax. The other one you'd have to pay state taxes, or maybe have to do that exclusion ratio. And I guess there's a strategy where some individuals may, make sure that an IRA that they have is only employer money that's not subject to state taxes. Because what happens is that when you calculate the RMDs, remember that you can take your 10 IRAs and calculating your distribution for the entire group, that you do that, but when you pull out the money, you may as well defer taxes as much as possible. You're pulling out of the IRA that's just the ones that's exclusively employer contributions. So you're pulling out the RMD and satisfying that requirement by pulling money out of the IRA that is not subject to state taxes. That's the strategy.
If you retire in like Nevada, no state income taxes, you don't have to worry about this. That doesn't come into play at all, right?
Yeah. Actually, that's kind of interesting because what had happened was that it's been a while now, but there was a law change on that. Because what would happen is that, especially California was notorious, that if you worked in California and you had retirement savings in California and you moved to Nevada, their position was that the amount that was saved and generated in California was so they would kind of go after you. But there was a federal statute that basically says that's no longer permissible. So they kind of go in. Just everybody's going to move to.
Yeah, why not?
But you got to be in Nevada.
There we go.
Something about the required minimum distribution is that there's a rule that says that. So say you're entitled, that's the one where you're 7.5 and you got to pull out money, and then you got to pull out, say $20,000. There's a rule that says that if you are required to take it out and you can basically direct that payment to a charity, then it's treated as if that $20,000 is never includable in your income. And it's like a charitable deduction, except that it's a charitable deduction without limitations. Because if you were to have to take that money out and then contribute it to the charity, you'd have to deal with the phase out of your deductions under your Schedule A itemized deductions. So this way you get the full value of all of it being outside of your income. Now the rule there is that you have to be 7.5, and it's also the rule is that it cannot exceed $100,000 on an annual basis. So. Okay, kind of a few minutes here. I wanted to mention something, not so much, it might be something that we might have to deal with because of what we had done in the past, but I know that sometimes when you're starting out in life and you get to your first law firm and then you have a family, you have a mortgage, and you have a wife and some kids, and then you've got to be concerned about life insurance, which might be the prudent thing to do. Well, a retirement plan can invest in life insurance, and so that's a circumstance where you can have pre-tax contributions going to the plan, and the plan would then use those amounts to pay the premiums. And under the plan, the plan would be the owner of the policy, you would be the insured, and the beneficiaries would be your wife and children. And when you do that, the plan would would view it as if they're providing you insurance coverage. And so it would determine what is the value of that insurance coverage and give you a 1099 on it to reflect that. But on that coverage, it's a table that's, I think I put it here, it's like when you're young, it's 87 cents per $1,000 of coverage. It's pretty modest. So what happens is that you're paying for the insurance with after-tax dollars. There's a bit of a income inclusion that you have to pay taxes on it. If you die, like other insurance that you kind of paid for with sort of after-tax dollars, your beneficiaries don't pay any taxes on it. And but it might be just the most feasible way for some people to handle it. And over time, it's maintained. And at the end of the day, you could buy out the policy, take a distribution of policy, and there's ways of getting the policy out. So. Finally, there's want to comment that there are there's a whole different in this area can do with a lot of topics, but one topic is the way your assets under your plan are invested, and just to say that the plan is a trust. The trust holds money. If it's an employer, the employer that has staff, everything has to be non-discriminatory. And there's usually investment programs that must be prudent. But most plans allow you to, and if it doesn't allow you to write it to do it, is that there's segregated investment account where you could basically take your money and direct it in particular securities that you wanted to. But also some people, over the course of, is that they buy raw land, they buy the condo in Makiki because they believe real estate is more reliable than the stock market. They buy a coffee farm. I'm just saying that the assets are sort of open-ended as to what they could be. But the main thing is that if you do that, you do it in a way that that money is not the money of your secretary, it's your money, and if there's so you don't get challenged by some kind of fiduciary breach or things like that. But what has happened sort of recently, a trend are these IRA providers that are marketing self-trusteed IRAs where they provide the IRA for you to take the money and buy real estate and the other thing is closely held stock. It used to be in the older days was that in order to have these plans, you'd have to deal with bank-wide first, an institutional trustee, and for that it was kind of difficult. The economics was difficult because the asset would be asset-based fees, especially with closely held stock. If you have money there and you want to make an investment for a closely held corporation, just as a piece of paper, and whatever it's valued to be, then fees are. But anyway, these providers now are selling that service to provide for trusteed IRAs. I don't think anybody locally, but they do market locally. I can talk to you about your question later.
Yeah, I want to talk to you about that.
Yeah.
How do you determine the required minimum distribution when you've got everything in real estate?
Oh yeah, see that's one of the problems, right? Is that one of the problems is that to do the required minimum distribution, you need liquidity. I mean that's what I was thinking. That was the problem. But in terms of the required minimum distribution, it's like no different. You're going to have to get an annual value. That's the problem with those properties too. If you have a retirement plan, you're going to have to file a 5,500 each year, and you're going to have to reflect the value, which means that you'd have to do, if it's company stock or employer securities, closely held stock, you're going to have an appraisal of that, including real estate. So based on that value, you're doing the same thing. What is the value as the last year, the preceding year, dividing it by the divisor, getting an amount, and you got to pay that out in value. And the question is, how do you do that unless you have some liquidity in the plan as well? So, but you got there's no buy on that requirement. You got to still do it.
Time is just about up. Maybe one or two more questions, and then You can talk to him afterwards for what, $1,000 an hour or something.
I wish, huh? Nah.
Any last minute questions, anybody?
I got a question. If I had a qualified pension plan and I rolled over, say, 500,000 into an IRA with a lump sum distribution, any gains on that, like say it went from 500,000 to 700,000, I'd have to pay tax, state Hawaii tax on the 200,000. The gain?
In the IRA,
Yes.
when you take it out from the
Yes,
IRA.
when I take it out.
Yeah, so yeah, based on what I said, the question is, when it was in your qualified plan, that 500,000,
Yes.
that money was attributed to what? If it were attributed to the company contributions,
Yes.
then that proportion is excluded.
Yeah.
So right, so it's a conduit IRA, so you kind of, that division between employer money and employee money, you maintain that sort of fraction going to the IRA. And so in your case, whatever that proportionality with the 200,000 in income would be, part of it would be taxable, part of it wouldn't.
That's when you pull it out from the IRA.
When you pull it out from the IRA.
So is the
When you're earning it, it's fine.
So is the 200,000 not subject to state of Hawaii income tax? The gain, or you?
Okay, I guess I'm saying that, the 500,000 that you pulled out.
Yes.
Let us say it's 500 of principal.
Yes.
If 300,000 was company money and 200,000 was your money, then when you have the 200, it's 3/5 going to be company money. 3/5 would be excluded.
Okay.
From state income tax.
Yeah, state income tax. Yeah, and federal income tax. So.
You're talking about the profit sharing, right?
Huh?
You're talking about profit sharing, right, the employer contribution.
Yeah.
As opposed to the safe harbor. Right?
Okay, thank you very much for attending. Let's give John a